Hey, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This coming week is going to have a big focus on the UK economy with the likes of the inflation rate coming out, the Bank of England interest rate decision. And then on Friday, we're going to see the PMIs, the retail sales numbers coming out. So plenty for us to sink our teeth into and plenty to ensure volatility for the likes of the FTSE 100 and the pound over the course of the week. So let's get into some of the key elements within this week's data. First and foremost, expectations. What are we expecting? Crucially, we're expecting to see headline inflation drop below 2%. So 1.9 expected on the headline number. That could cause plenty of optimism within markets as we think that essentially they've beaten inflation. It's back below target. But there's still some caveats here, and you can see that just below that line with 3.9% core inflation expected to see a sharp decline, but coming in at 3.2. So it's still well above expectations or well above target, pardon me. And it's worth noting headline inflation is crucial, but headline inflation also encompasses a bunch of things that the central banks have very little impact over, the likes of food prices, food imports, and the likes of energy prices. They're not necessarily the kind of things that their monetary policy will combat. And so in the same way as the Federal Reserve likes to utilize the core PCE number, the Bank of England will certainly want to see that core number moving towards the downside. So it's a good chance we see plenty of optimism on Wednesday. If we do see this decline through that 2% mark in headline inflation, you could see some headlines essentially to the effect of, we've beaten inflation now over in the UK. But when it comes to the Thursday Bank of England rate decision, how is the Bank of England going to take this? Are they going to focus on the positives and say, now that we've got below 2%, we can cut interest rates over the near term? We could see them cut interest rates at the meeting, quite frankly. It's an outlier event. But certainly, given the fact that inflation could be at or below 2% by that point, there's still a good possibility of that. Or do they focus on those core metrics and say, look, we've still got some key elements of inflation we want to drive lower. So we're going to take a relatively cautious approach and maybe wait a couple of months. September currently priced as the most likely time that we see the first interest rate cut. Back end of the week, we've got retail sales, which of course is a good proxy for consumer behavior. How is demand shaping up in the face of high inflation, high interest rates? And we've got the PMI numbers coming out, which in particular we'll be watching out for the services figure. And I'll show you why a little bit later in this. So here is a chart showing the different types of inflation will be released within the inflation report on Wednesday. As we can see, the trajectory has been ideal, really. We saw a massive rise in terms of inflation with CPI topping 10%, moving into double digits. We saw the same kind of thing again, as we can see here with the RPI number, but all of them moving on a nice downward trajectory in terms of headline inflation. Well, here's the breakdown, 2.3% in terms of inflation as it stands. What we can see here is that the last metric on a monthly basis was 0.332. And the figure that we're seeing stripped out from May of last year is 0.674. So you can see quite easily how any sort of replication of last month's figure or below in terms of the monthly number would likely take us back to 2% or below. So there's a very strong chance that we do see inflation back below target. And of course, we've seen energy prices coming down of late as well, which helped things certainly over in the US, as we saw with their latest CPI numbers. The 11-month annualized figure that we can see here is below the 2-month mark, which essentially says if this coming reading is an average figure for the numbers seen over the course of the last 11 months, then where would we be? So in actual fact, it could come in below 1.9 if we do see a sort of average number. But it's worth noting the last 3 months have been relatively lofty. But then again, you look at the US CPI number, came in at 0% for the month. So there's even a chance that we could come in below that 1.9 figure. 2.24 is the 6-month annualized figure, which highlights the fact that, maybe over the medium term, inflation moves back above that 2% mark in terms of headline inflation. But, I don't think they're necessarily going to be picking the bones through, if it's anywhere above 2%. If we get down to 1.8, 1.9 now, and in a few months' time we're back at 2.1 or something like that, 2.2, I don't necessarily think the Bank of England is suddenly going to freak out and start thinking that they need to be tightening or holding off for an extended period of time. We'll have to be following those monthly metrics. Certainly the last few months haven't been too favorable, but hopefully we're going to see a nice low monthly figure this time around. In terms of the core figures, we can see that the figure dropping out from last time is 0.814. That's why we're expecting to see such significant disinflation this time around. Markets expecting to see that 3.86 figure coming back towards a sort of 3.3, 3.4 kind of area, the lower parts of the threes. And that's because we're expecting to see this core reading significantly below that 0.814 that we've seen last time around. In terms of the 11-month annualized, the 6-month annualized, all of it points towards us remaining above that 3% mark. So certainly, if you look at the trajectory beyond May from last year, June, July, August, October, November, all in relatively low numbers, it's going to be difficult for the Bank of England to see inflation back below 3% anytime soon, quite frankly. I mean, you look at last month's reading, 0.92, right? That's essentially half of the 2% within 1 month, near enough. So core is going to be a problem. If they want to get core back down to 2%, we could be waiting for a long time. But as long as they're going to be focusing on that headline number, then all is good. And that's why the commentary around that meeting on Thursday will be absolutely crucial. I don't necessarily think we're going to see that interest rate cut because we have this wide disparity between core and headline. And I think they will want to drive down that core inflation. In terms of underlying inflation pressures, we have seen wage pressures flatlining essentially. We can see here at the latest average earnings figure, you can see largely sort of tapering off in terms of the pullback. Now, of course, the number that we want to see decline is the CPI number. And so that gap, that disparity between inflation and between earnings growth does point towards an improvement in living quality here in the UK, with real earnings on the rise, as we can see, following that protracted decline that we saw over the course of 2022 and 2023. So things have improved on that front. But bear in mind, this is inflationary. If we see people earning more than the price of the goods that they're buying is rising by, then they can buy more goods, and that increase in demand potentially raises inflation going forward. But nonetheless, I think that's a good story for the UK economy, because real earnings did take a bit of a battering over the course of a couple of years, and the fact that they're back in positive territory and rising, I think, is good news. In terms of the breakdown for inflation, this is from ING. I think this is really interesting. Of course, we're looking at a potential decline back through that 2% mark. So you can say the job has been done. But if we're looking at the breakdown in terms of where the inflation and disinflation has come from, you can see the disinflation has come from energy over the course of the past year, essentially, with those purple segments along the bottom. That is fast running out. So the downside effects of energy prices largely fading out. And what we can see here is pretty much the entire thing is taken up by services. And so services inflation remains absolutely key here. Goods inflation, not a problem. And if we look at sort of where we were prior to all of this, you look at 2020, it's a similar kind of thing. A lot of it is coming down to the services sector, but any shrinking in terms of this inflation number is going to have to come from the services sector. And that really is where we need to drive things down if we're going to see the likes of the core number moving towards the downside as well. So services really is where it's at, and that highlights why we're going to be paying close attention to the PMI number coming out on Friday. The latest services PMI number expected, if we drop back to the beginning, expected to rise up to 53.2. Within that, it's worthwhile looking into the breakdown in terms of exactly what's happening in terms of price pressures within the sector, because you see these numbers, but when you click into the report, it gives you much more information in terms of what's happening. And we really need to start seeing that the price pressures within the services sector declining. That would give us greater confidence that we will see the Bank of England cutting interest rates over the near term. That services PMI number also has a decent correlation with the likes of cable, as we can see here. If we see weakness in terms of the services PMI, generally that points towards weakness for the pound against the US dollar. Whereas if we see a strengthening, then potential strength for the pound. And that's because if we're seeing weakness of the services sector, we're likely seeing weakness in terms of the UK economy, and therefore we're potentially going to see the Bank of England taking action as a result. But this time around, we're expecting to see strengthening services sector, which, that could maybe hinder any downside that we're seeing for the pound. In terms of expectations for this Bank of England meeting, we can see here, like I said, it's a roughly 10% expectation of a rate cut this time around, but things start to really ramp up as we move forward. The expectation is around 40% for August, and then we come into the base case scenario of the first cut coming in September. As we can see here, just 35% chance that we still have rates steady at 5.25 by that point. By the end of the year, we're expecting to see another rate cut coming into fruition at least. So 2 rate cuts currently being priced for this year, with the expectation of a third rate cut currently being priced around 40% chance. So certainly, that's for February. So we could potentially see 3 rate cuts by a 40% chance by February. If we're looking towards year end, markets only pricing just over 20%, so 23% it looks like. So by and large, just 2 rate cuts this year expected from the Bank of England. But if we see inflation drop below 2%, and if we see the Bank of England coming out with particularly dovish tones, then we could see a repricing in the direction of more rate cuts this year. I think a September rate cut, there's a good chance we could see a growth in expectations for an August rate cut, and that could then start to tip the scales in the favor of 3 rate cuts this year. So look out for that commentary around the Bank of England decision. That's going to be absolutely key for the week ahead. Now, in terms of the charts, this is the FTSE 100. It's been under pressure of late. Currently, we're seeing pressure across a number of different markets, most notably in France, where we've got that snap election and things are looking a bit of a mess from a political standpoint in France. But nonetheless, pulling back, we can see the wider trend is a bullish one over recent years. The pullbacks taking us in towards this trendline support. So between the 61.8 and the trendline support, there's a good chance that near-term downside could be limited, especially if we see a nice decline back below that 2% mark in inflation, and especially if we see the Bank of England start to lay the groundwork for a potential rate cut in August rather than September. So the near-term pullback is ultimately a counter trend move. The primary trend is a bullish one, and therefore this trendline support, Fibonacci support, looks like an interesting area for us to potentially come into and find that the buyers come back into play once again. But certainly, another way is saying, we need to look out for this near-term intraday trend to end for us to feel confident that the bulls are back in charge. And that would take a rise up through your near-term swing high, which is here. It's not there. That's percentage terms, which is here at 8243 for the FTSE 100. Then let's look. Sorry, let me just get rid of that line. I'm going to get rid of these as well. There we go. And then I wanted to show you the pound against the US dollar. Now, of course, the FOMC, from my perspective, and I've been talking about it for a long time, have a problem when it comes to inflation. I don't see them cutting interest rates anytime soon. Currently, markets pricing a single rate cut this year. That might not even happen, quite frankly. And so that bodes well for the US dollar because it's a risk-off play. It's a sort of carry trade play in favor of US rates if we see interest rates cut elsewhere. And so if we do see the Bank of England coming out relatively dovish, if we see inflation drop below that 2% mark and people feeling like we're going to see an interest rate cut over the near term, we could see this market top out. And certainly it's worth noting that we saw this strong rally back in towards this area of resistance that we have here, sort of 1.29 area down to this area 1.282. So these peaks, we've rallied into it, flush lower since then and been rolling over. So crucially, we need to be looking out for this near-term support level of 1268. If we break below that level, we could be paving the way for a bearish phase coming into play here for the for cable. So look out for that support level. In particular, if we see that decline through 2%. We see a dovish Bank of England. Things could shape up for a period of weakness here for the likes of cable and the pound as a whole. We have seen euro sterling flushing lower recently after that interest rate cut from the ECB. Maybe we could see a move pushing it back against that if we saw the Bank of England coming out with a relatively dovish stance on Thursday. But plenty to sink our teeth into over the course of the week. Certainly the possibility that we're going to see a decline through that 2% mark in terms of inflation does bring the basis for optimism on Wednesday. Whether the Bank of England are going to play alongside that and increase it with a dovish stance of their own, that remains to be seen. But it's going to be a volatile week for UK stocks, for the pound. But that's a good thing because particularly for the UK, it's a good news story if we do see a drop back below that 2% mark and it starts to differentiate the likes of the Bank of England from some of these other central banks, most notably the likes of the RBA, where we're expecting to potentially hold rates for the entirety of this year, and a similar kind of thing for the FOMC as they struggle to drive inflation back down certainly from the CPI areas, core and headline CPI, I think are likely to stay mid-threes for an extended period of time. Whether they can just focus on the core PCE number, which is at least in the twos, that remains to be seen. But certainly plenty of interest ahead for people trading the pound and the FTSE 100.